Well, good morning, everyone from Washington, D.C. I'm Ken Carrar. I'm President and CEO of the Council of Insurance Agents and Brokers. The Council is located in Washington, and we represent 200 of the top commercial insurance and employee benefits consultants, including your brokers. Your brokers are the top market leaders and members of the Council. They've made an investment in the Council because they understand the value and importance of having a voice on Capitol Hill and having a strong legal counsel, and can leverage the collective power of other market leaders so they can advise and provide you with timely and relevant intelligence and information you need to manage your business. These unprecedented times we're all grappling with the uncertainty that lies ahead, and your broker continues to be among your best advocates through these times, the best of the best. Today, you've been invited as a client of our broker members as we unpack the complexity and specifics of the Small Business Administration's Paycheck Protection Loan Program under the CARES Act. Navigating the federal legislative and regulatory landscape is one of the cornerstones of what the Council offers its members, and we are joined today by our top-notch legal team at Steptoe & Johnson, who've been working around the clock to dissect and clarify the specifics of this program. I'd like you to feel free to ask questions through the Q&A box, but please pose your questions at the end of the presentation because your questions may get addressed in the presentation. We'll do our best to address as many of those questions as we can. We are recording today's webinar, and you will receive a link to the webinar after the program ends from our office. If you have additional questions afterwards, you can link through to the webinar and should be able to pick up the answers. If you have any technical challenges with the webinar, please use the chat box just for technical issues. That's just technical issues. So now I'd like to turn it over to Scott Cinder and Kate Jensen of Steptoe & Johnson as they unpack the Paycheck Protection Loan Program. Scott?
Thanks, Ken. Good morning, everybody. So we're going to try to walk you through. We're going to cover three main things. We're going to cover the core of the SBA's Paycheck Protection Program loans, and that will be the bulk of the presentation. And at the end, we're going to cover two additional topics. One is that there are some employment tax-related benefits available to businesses that you give up if you participate in the program and you receive loan forgiveness. So we'll cover those so you know the alternatives. And at the end, we'll lightly touch on larger loan programs for larger businesses, about which still a lot is not yet known, and we intend to do a follow-up webinar when parameters for those programs are set. Zach, you want to go ahead and move to the next slide? So this is an outline of kind of the basic parameters of the program. Some of these issues we're going to delve into more deeply as we move forward, but it's a very, if you can participate and you're eligible, we think it's a very aggressive program. 100% of the loans that are provided through this program are federally guaranteed. There are no personal guarantees on the loan. There's no recourse against any individual who owns a business that gets a loan here. The purpose of this is really to make this as easy a program as possible for the banks to administer. We're going to talk a little bit about that more later because despite the best intents, that's not actually seeming to be true yet in the marketplace. There's a $10 million cap on the overall loan amount that you can receive through the program, and otherwise it's a function of your average monthly payroll in 2019. The loans that you do receive have a 2-year maturity with an interest rate of 1%. This was a change from the initial rules, which had have that interest rate, but the banks rebelled essentially. So they raised the interest rate to 1%. But no one will have to begin to repay any of the loans for at least 6 months, under which there'll be no principal or interest payments required. The key feature, and we'll spend some time on how you qualify for this, is that you can get full forgiveness of the loans if you satisfy the program requirements, meaning that you don't have to repay the loans, so they become more of a grant than a loan. Zach, can we go to the next slide, please? So who's eligible? Small business concerns as defined in current SBA laws and rules. Now there's been one tweak on this in the regulations, and if you're familiar with the SBA regime, Under their normal programs, you can qualify. There's a 50-page list of industry codes, and for each industry code, there are different employment and revenue requirements. If you are underneath either of them, then you normally qualify. The rules indicate that they're only looking at the employee counts now. They're not looking at the revenue counts. There's been some questions about that. The SBA may still tweak it, but right now it's just the number of employees. And these are the new requirements in the CARES Act. If you're under 500 employees, so many of those codes require sizes of employers under much smaller than 500 employees. 50, for example, in some segments, can be up to 500 employees, or the SBA small size standard for the employees in your industry. So for some manufacturers, for example, those sizes can be up to 17 or 1800 for some of the manufacturing sectors. This applies to all for-profit businesses, as well as 501c3s, 501c19 veterans organizations, and tribal businesses that satisfy these size thresholds. There are special rules that were issued on Saturday morning for faith-based organizations that essentially allows them to qualify without consideration of the overall church network that you are in. So in other words, each Catholic church will be able to apply on its own without regard to the entirety of the Catholic Church system. Zach, do you want to go to the next slide? And Kate's going to delve into a little bit of some of the details on the exceptions. Oh, no, she's not. She's going to talk about ineligible entities.
And then we're going to talk about some of the accounting rules. So one of the things that came out as part of the guidance that SBA issued late last week is that they are incorporating a list of businesses that normally are ineligible for SBA loans into this program. The big exception there is normally nonprofits and churches are not eligible for SBA loans. They are eligible for these paycheck protection loans. So what's on your screen now is just an example of some of those businesses that remain ineligible for these paycheck protection loans. So for instance, if you are a lobby shop here in DC, you are primarily engaged in lobbying, you're out of luck. Same if you derive more than 1/3 of your gross annual revenue from legal gambling activities. So Zach, I think we can go to the next slide.
Go ahead, Kate.
Right, Scott, you want me to go through this?
Yeah.
Okay, so for the folks who are not categorically excluded from eligibility for the program, here's how you count your employees. So generally, you will count all full-time, part-time, and other basis employees of the applicant and also of all of the applicant's U.S. and foreign affiliates. So there are a couple of exceptions that we're going to get into there, but the general rule for the vast majority of businesses is that you need to do an all-in count of your employees across all of your affiliates. Other basis employees under current SBA rules do include folks like temps that you may get from a temp agency, or folks who come to you from a professional employee organization. So I would count those folks in up to your 500 employee threshold. And then in terms of affiliation rules, over the weekend, they released rules for this particular piece of the program. They will look to 4 tests to see if affiliation exists between the applicant and any other business. You can see there a list of what those tests are going to be. I think the 50% plus equity ownership or common management are going to be the ones you really want to look out for most folks. And then the bottom half of your screen there lays out a couple of special accounting rules for certain industries. So as Scott mentioned, SBA maintains employee size requirements usually under these NAICS industry codes. If your industry code starts with a 72, so that's generally accommodations and food service businesses like restaurants, you get to count your employees per location. So you can have up to 500 employees per location. And they have waived those affiliation rules for those 72 code businesses and also for franchises operating under an existing SBA franchise code. Same with faith-based organizations. The affiliation rules will be waived for them as well. Jack, I think we can go to the next slide.
Well, I can pick it up, Kate. Then, so we've been modifying the presentation, so it's kind of impacted our trading off. On the special accounting rules, business concerns under the SBA is any entity organized for profit with a place business located in the U.S. and which operates primarily here, or makes a significant contribution to the U.S. economy through its payment of taxes or use of American materials or labor. That's just the quote. Any legal form of entity may apply, individual partnerships, proprietorships, LLCs, etc. One note, and we'll talk about this a little bit more in the payroll piece, but owners of those businesses, there's a lot of questions now, if you're an LLC or an LLP, how you factor in, whether you're self-employed technically under the rules or whether you could be counted as part of your business. You would count as part in terms of your eligibility for size standard, but it's unclear whether or not you would count for your payroll piece in determining the loan size. For those 72 NAICS codes, you count per location, and you can apply per location. For most of the restaurants and hospitality industry businesses that we've been talking to, they generally have separate corporate entities associated with locations or group of locations. There's a pragmatic element to this in terms of what the banks will accept, and I think that the more you can apply through an actual entity with a separate EIN number, for example, I think the easier your process is going to be. Kate also mentioned the SBA franchise identifier codes. The impact of the affiliation rule waiver means that normally you would aggregate all the businesses that are jointly owned or controlled, including restaurant or hotel businesses, and you look at their overall number of employees across all the entities that are related. And if you're over the thresholds, then you're not eligible. So the waiver means you don't have to look at those affiliates, you just look at the business applying for the loan. Why don't we move to the next slide? So the application process. So I want to start this by saying that there are rules and there's what's happening in the field. So we're going to go through the rules. And what's happening in the field is that each bank is sort of taking this on for themselves to the extent that they're playing here. And it's caused all sorts of complications because they're imposing additional standards. For example, there's a local bank in DC that has a whole list of additional requirements that it's imposing on its applicants for submission. And many banks are only allowing their own borrowers or their own customers today to apply through those banks for this loan. So the loan, the application from the Department of Treasury, it was modified an hour before applications began to be taken at midnight on Friday morning. But the new application includes some basic business identification information like your EIN and your NAICS code, a list of all owners with more than a 20% ownership stake in the company or whatever form it is, a list of any businesses under common ownership or management with the applicant, and you attach this as a separate attachment basically on which you list them. Details of any of the emergency distress loans that you may have received between January 1st, 2020 and April 3rd, 2020, which you're allowed to roll in to your borrowing here. And then some special information about individual applicants and each of the more than 20% owners, criminal history, and a few other certifications. One good change is that the form has to be certified by a business representative, but only one individual has to sign on behalf of the business, and each of the 20% or more owners do not have to independently sign. In addition to the basic information, the only required attachment other than affiliates is submission of payroll documentation. It appears from the application that lenders are going to require calendar year 2019 data, although the rules use the last 12 months as the look back period. I think there's an operational element to this that aligns with tax returns, and that's why the banks have gone that way. Zach, can we move to the next slide, please? Sorry.
So I can pick up with this one. So as Scott mentioned at the top, Treasury and SBA are encouraging the banks to process these loan applications and get the dollars out the door as quickly as possible. So what they are is essentially doing here is, in lieu of the bank doing its own due diligence for underwriting purposes for these loans, the banks are allowed to rely on your payroll documentation that you submit and these certifications that you see on the screen right now. So for instance, you self-certify in good faith that you think you are eligible for a loan. You certify that you need the loan to support ongoing operations during the emergency. So as Scott has mentioned on a couple of other of these presentations, if your business is booming right now, compared to say, how it was doing in February. So for instance, if your business makes medical grade face masks, you may have a difficult time certifying to this particular point, but most people will be able to say pretty clearly that their operations are suffering because of the emergency. A few other things here: you promise that you will provide the documentation that they need after your loan is originated to determine your forgiveness amount. You have to promise that you will not receive any other Paycheck protection loan this year. And we are not sure if this program is going to go through another round of appropriations to get additional funding from Congress. It's looking more and more like that is going to happen. So what we may end up with is a new pool of money later in the year that will become available to applicants who apply here in these early stages of the program. We don't know that yet, but you will not be able to apply for another loan, a separate loan this year under the program. And then you have to essentially acknowledge that your loan amount is going to be originated based on the documentation and the calculations that you submit to your bank. Again, that documentation is really going to be bank specific, so we really encourage folks to reach out, determine exactly what your lender is going to require. But one thing we'll point out from the latest Treasury guidance is that the loan amount calculation is going to be on the borrower. So when you submit your payroll with your application, it's not on the lender to go through your documentation and figure out what should be included and what shouldn't. It's on the applicant. This, again, is just to get the banks more comfortable with the operation of the program and get those dollars out. But that becomes relevant as we go through this slide deck presentation, because you want to pay close attention to what you should and should not be including. I think we can go to the next slide.
All right, so maximum loan amount. So your loan amount is generally going to be 250% of your average monthly payroll costs. The statute says during the last 12 months, the application says 2019 calendar year. That's likely to be better for most businesses anyway, or perhaps you shouldn't be applying because you won't be able to check that distress box. So hopefully that will be okay, but that does appear to be what the lenders are requesting. The most you can take, though, is $10 million. So if 250% of your average payroll cost exceeds that, then you will be capped at the $10 million. Why don't we go to the next slide? And Kate, the uses and the loan amount for payroll costs is the same. So Kate, why don't you kind of walk through the payroll cost calculation and pick up the rest on uses.
Right. So that payroll cost bucket, guys, is the most important bucket for a couple of reasons. One, as Scott just mentioned, that is going to be the basis for your loan amount calculation. 250% of this bucket alone is going to determine your loan amount. Also, Treasury dropped a little bit of a bomb at the end of last week and said that they're going to require everyone to spend at least 75% of their loan proceeds on payroll costs. So this is different from how I think a lot of people were expecting the program to operate. There are no such restrictions in the statute. So this is really Treasury and SBA exercising their regulatory authority to really drive these dollars toward payroll. So that leaves 25% of your loan amount for everything else, the entire rest of the permissible expenses universe that you see on your screen here, which does include group health benefits, insurance premiums for any insurance that the business has, interest on debt obligations. You cannot use the loan to pay principal amounts, but you can take care of your interest payments. So a couple of additional things to highlight in this payroll cost bucket before we move on from this slide, because payroll costs also will be relevant to your loan forgiveness amount. Key things here. First, what they did was they cut out independent contractors and sole proprietors from what business applicants can include as their payroll costs. So the way the statute is written, it sounds like you should be able to include your employees and then any 1099 independent contractors you have within your payroll costs. They have actually clarified that no, that's not the case. The independent contractors and sole proprietors are expected to go apply for their own loans. So that's where they will cover their compensation. So for employers, you will look only at your employee compensation. You've got to cap that compensation at a $100,000 annualized amount per individual. So effectively, any individual can receive $8,333 per month under this program. Severance payments, group health benefits, retirement benefits, and the only employer paid taxes that you should include in that amount is state and local payroll taxes. So we get a lot of questions about FICA and other federal tax payments. The statute does not allow you to include those in these payroll costs. You'll see a couple of explicit exclusions from payroll costs at the bottom there. So again, any excess compensation above that 100,000 amount, you need to chalk that off the top. Federal taxes, compensation to non-US employees. And then for any of you who are obligated under the Families First Act to provide paid leave to your employees, the way the Families First Act is structured, you're going to get dollar for dollar tax credits for those paid leave wages. So in order to avoid a double dipping scenario, you actually need to take those wages out of any payroll cost calculation.
The only,
slide
I would add just quickly that group health care benefits, they are part of payroll costs. So when you're making the calculation on both ends, they count. We split them out here differently because we're so attuned to them, but they are kind of enrolled in payroll costs to the extent that they're group health benefits being provided to employees. All right, Zach, now let's do the, so I like this part because I tell you everything you can get and then Kate tells you everything you can't. So the maximum forgiveness amount is capped at what you actually get on the loan and any accrued interest. So you can't get an additional payment from the federal government for exceeding your loan amount. But it's payroll costs defined exactly as we did above, interest on mortgage obligations, rent obligations, and utility payments, all for obligations or services that were in place prior to February 14th. So this would not apply to, for example, a new mortgage that you took on in March. The idea here is to try to incentivize quick deployment. So when you look at the expenditures, it's in the 8 weeks following your origination date on the loan, which should be the date you get the money. Any dollars spent after that don't count in the calculations. And by virtue of the new rules, at least 75% of that money has to be spent on payroll costs. Let me just pause there just for a second to note this. There are a lot of gaming that people were discussing about waiting to rehire people, and Kate's going to go through sort of the way you catch up on the people that you have laid off or furloughed so that you fully qualify for loan forgiveness. And I think one reason they put in this element that you have to actually spend 75% of your money on payroll costs was to try to get at some of that gaming that was already being heavily discussed and written about. So Zach, why don't we go to the next slide and Kate can dive into that.
Okay, so what Scott just walked you through is sort of the ceiling, the maximum possible amount you will be able to receive for forgiveness on your loan. So again, anything spent outside of that first 8-week period doesn't count. Anything not spent on in those 4 permitted buckets doesn't count. So you may be starting from a ceiling that is actually lower than your full loan amount. So what I'm going to walk you through right now is actually, it's going to be a reduction from your full forgiveness amount. So essentially, if you, during this 8-week period following when you get your loan origination, if you do not bring up your average full-time equivalent employee number to pre-crisis levels, you're going to get dinged on that maximum forgiveness amount. You're also going to get dinged if you do significant wage reductions, so anything over 25% for people who make less than $100,000 per year. We think you can cut salaries for folks making more than that all you want, and you'll be fine. No penalty for that. And then if you take advantage of any advances that are available under the SBA's disaster loan program, they're going to take those advance amounts right off the top as well. So these are the ways that that maximum forgiveness amount will be reduced. And then, as Scott mentioned, there's an opportunity to sort of get back up to that maximum forgiveness amount if you true up your payroll essentially by June 30th. So if you rehire and you get back up to that full-time equivalent employee average by June 30th, and if you make up for any of those payroll cuts by June 30th, then none of those reductions in that top category are going to apply to you. You will get your maximum loan forgiveness amount. One thing we've been getting a lot of questions on, because of course, you know, this program is designed to get the dollars spent and your payroll back up to what it was in the first 8 weeks of your loan. But now it's looking like the emergency is going to last a lot longer than 8 weeks from now. Businesses will be closed a lot longer than 8 weeks. So folks are, you know, justifiably saying, well, what if my circumstances have not changed and it's week 9 and I have to start laying people off again? And we think the way that the statute is written and based on the rules we've seen to date, there are no longer term payroll maintenance requirements to get these forgiveness amounts. So if you do everything you're supposed to do in those 8 weeks, you file your application for your forgiveness amount. We don't think that there's any then forward-looking obligation to maintain your payroll beyond that point. Similarly, if you use this opportunity to rehire and increase wages by June 30th, same thing. We don't think that there is anything, you know, effective July 1st that would lock you into those employment numbers or those wage levels. So Zach, we can go to the next screen.
Go ahead, Kate.
Scott, you want me to just walk through this one really quick?
Yep.
Okay, so as I mentioned, you will do a separate application for your forgiveness amount. So what you're going through right now is the application to get your loan. There will be a new process for applying for forgiveness. At the end of your 8-week forgiveness period, so the end of the 8 weeks after your loan origination, you will be able to submit documentation to your lender showing that you brought those full-time employee average numbers up or that you didn't, and then they'll calculate your penalty based on that. And you're going to need to produce documentation showing that you spent your dollars in those 8 weeks on the things that you were supposed to. So be sure that you're keeping records like canceled checks, receipts, bank statements, so on and so forth, that can show exactly where your dollars went. And then again, under the CARES Act, you're going to have to certify, an eligible business representative will have to certify to the truth and the correctness of the materials that you submit. And if at the end of this whole process, it turns out that you have loan amounts remaining, so not your entire loan amount is not forgiven, the idea under the CARES Act is that the loan will continue with these very favorable terms. So would continue with the federal guarantee, the 1% fixed interest rate, 2-year maturity date. What is unclear to us and what we would just sort of caution you about is that if you do something you're not supposed to do, so say, for instance, you don't spend 75% of your loan dollars on payroll costs, we don't know yet what the penalty might be for that, right? So there's a possibility that in future guidance, SBA and Treasury will say, you only get the benefit of these really favorable loan terms on any remaining loan amounts if you have followed the letter of the law and the regulations to a T. So just to avoid any complications, any surprises at the end of that forgiveness period, we really encourage folks to pay careful attention to these rules. And Zach, I think we can move on from this one.
The only thing I would add there is that the guidance from the SBA on the forgiveness is not due until April 26th. So you'll have your loan in place and be underway before we know some of those details. But I think if you do as Kate outlined and use the money for the purposes permitted under the Act, you should be in good shape. There are 2 tax benefits that were created under the legislation that you need to know about and that you would be sacrificing if you participate in the program or if you get forgiveness for one of them. So the first is the CARES Act established a new employee retention credit. You're not eligible for this if you receive a loan under the program. The credit provides eligible employers with a refundable credit against payroll tax for the first 50%, for 50% of the first $10,000 in wages per employee, including the value of health plan benefits. This is going to be calculated on a quarterly basis. So you'll look at the second quarter, and if you qualify, and somebody made $8,000 that quarter, you get a 50% credit, and then you can take the rest of the credit in the third quarter if you still qualify. How do you qualify? You've experienced at least a partial suspension operations due to government orders. Now, this was written before a lot of the shutdown orders, and so it'll be interesting to see how they think about that. Or you've had a year-over-year reduction in gross receipts of at least 50%. If you have more than 100 full-time employees, you're only allowed to take the credit for employees who are currently not providing services because of the COVID-19. So only those would be eligible for the credit. So you sacrifice that if you get a loan. If you get forgiveness, you also satisfy postponing the date for depositing your employer payroll taxes and certain self-employment taxes attributable wages. So what the law says is you're allowed to defer that half until the end of 2021, the other half until the end of 2022. There's no qualification for that other than you have the obligation. Any business is able to take advantage of this, or any nonprofit, provided that they haven't received a loan that's been forgiven under the program. So, this is a math issue. Looking at your businesses and what the advantages and disadvantages is of these options versus obtaining the loan for you to decide which is more favorable for you. Zach, next slide, please.
All right, so this is just a snapshot of sort of key dates, a couple of which have already passed. So we do have final rules in place from the SBA and Treasury. They also posted a new FAQ document on Treasury's website Friday night and indicated that they will just start adding guidance as they want to make clarifications. So we expect this to kind of keep coming at us on a rolling basis. So, I would check that Treasury site early and often to see what additional details are coming out. The loans are already technically available for small businesses and sole proprietorships, although as Scott said at the beginning, some banks are more prepared than others to start accepting these applications. So this is kind of a case-by-case start date at this point. And then starting next Friday, the loans will technically be available for independent contractors and self-employed individuals. And then finally, as Scott mentioned, we do expect to see another round of regulations out of SBA dealing specifically with those forgiveness issues. So to the extent you have questions that just aren't answered anywhere right now about how your forgiveness is going to work, we really hope that we will see those answers well in advance of the conclusion of that 8-week period when these loans do start to show up in people's bank accounts. Next slide.
Yeah, one thing I'll add there is we mentioned that there's going to be a link distributed so that you can re-watch the webinar or share it with others if they would like to watch it. We will also distribute a link to Steptoe's kind of guidance on the program, and everything that's been covered here is covered there as well, and I think a pretty nice, succinct fashion. And we're updating that on a real-time basis, so as we get more guidance, that link will stay current, and you can check for additions, and Kate will be sure to add an updated as of date so that you know you're looking at updated guidance. All right, now, Zach, last slide, please. So for those of you who don't qualify for this SBA program for one reason or another, there are other lending programs for medium and larger size businesses that are going to be available through Treasury. Right now, the only program that's live is for air carriers and cargo air carriers. Some of the Treasury loans are accompanied by some relatively significant restrictions on your go-forward activities. So for example, you have to continue to retain at least 90% of your workforce. You have to agree that you will not be anything other than neutral in any labor organization effort within your companies for at least 2 years following your final payment on whatever loan you receive. There's going to be a new Main Street lending program set up at the Federal Reserve. It likely will not have some of these conditions on it and will be cleaner money. We have no details yet on the parameters of that program. The chair of the Boston Fed that I think is going to be operating that facility said last week it would be at least 2 weeks before they had any guidance on it. So we will be updating you, as we noted at the outset. We'll have materials on this, and we'll likely do another webinar if there's interest in learning more about those programs when those details are available. So with that, Zach, why don't we go to the last slide, and we'll happily take questions.
Scott, I don't know about you, but none of the questions are showing up for me on my screen. So hopefully one of the council folks can see what's come in.
This is Ken. I can do that. And I would just point out to all those people who ask questions in the chat room, we can't look at those questions. We can't see them. So we would ask you to post those into the Q&A list. So let me go through, and try to pull out some of these. A lot of these are going to be answered in the presentation now that it's finished. How does payroll, it keeps bouncing around. What about government entities, county-owned hospitals? Would they be eligible?
Only if they're 501c3s. And I don't know their tax status, but if their tax status is a C3, which is a charitable tax status, they would qualify. I'd also note that there's a lot of other direct funding opportunities available for healthcare providers and hospitals outside of this program that may be quicker for them to access and may be more favorable.
Okay. I can't, my screen is just bouncing around. Can you please answer this for our board of directors? We are a 501c3. It appears we're eligible, but we are still receiving all income that we had prior to the pandemic. We're funded by the state of California through SSI for our developmentally disabled residential homes and day programs. If the state decides to stop paying us for any reason or cut our income, will that not be able to make us 2 weeks? I'm sorry.
So let me sort of phrase it how I think I would ask it. So on the application form, there's a question that you have to answer that says that you're experiencing distress or expect to experience distress as a result of the difficult economic conditions that are posed by COVID-19. I think you have to have some basis for answering that question affirmatively. It can't be, I don't think it can be speculation that something might happen. I think it's something you expect to happen. So if you've already experienced a slowdown in contributions, for example, if you're already experiencing a reduced revenue flow, then you can check the box.
Okay.
Yeah, and I'll just add one thing to that really quickly, Ken and Scott. Your payroll loan, the loan is calculated based on the average payroll costs paid by the applicant. So to the extent that you have funding streams that are paying for certain portions of those payroll costs, I think a careful read of the law suggests that you should exclude those So really only include those payroll items that you, applicant, are paying.
Scott, could you address the issue of 501c6s?
Yes, 501c6s are ineligible for this loan. I will tell you that I go to sleep every night with the CEO of a 501c6, and she's not pleased about it, and nor is Ken. And one of our objectives in the phase 4 of the CARES Act is to get them added. I believe that C6s are eligible for the distress loan program at the SBA. And so that's an alternative. It's not quite as favorable in that you have to pay the money back, but the interest terms are very aggressive for nonprofits. And so they're not a bad alternative.
Okay. I'm going to see. Are the this is bouncing around so much I can hardly read them. Can I count independent contractors on my payroll as an employee count?
So you count them for determining your size eligibility because they're clearly within the ambit of the way they define size. But when you calculate your payroll cost, you exclude them. That's not what the statute says, but that is what the regulations say that they've issued to implement the statute. So if you're a 1099 recipient, they expect you to be paid directly yourself by applying for your own loan if you're eligible.
Okay. Can you specify the exclusions list? Are landlords and real estate managing agents eligible?
So passive.
Yeah, so there's, go ahead.
Go ahead, Kate. Go ahead, you go.
So in terms of eligibility, there's nothing industry specific about the program. So if you are a for-profit business or a 501c3 nonprofit or a C19 veterans organization or one of the qualifying tribal businesses, no matter what your line of business, if you're under that employee count threshold, then you are allowed to apply for a loan. We've seen a couple of other questions that are related not to those groups actually getting their own loan, but can you pay those groups out of your loan dollars? The answer is yes, you can pay rent and interest on your mortgage obligations to anyone. There's no restriction on who can receive those dollars.
Are there any restrictions on publicly held companies?
No.
No.
Nope.
That was, if an entity really falls within 72 NAC codes, but has indicated another code such as 71 on its tax returns, will that negatively impact the loan application?
So their primary revenue has to be under the qualifying code.
Okay. Let's see. Are there 4 tests for common ownership based on an or definition for each test?
Yes.
So this is a question. So normally the way the SBA handles their affiliation rules is it's a totality of the circumstances analysis. So if you don't satisfy one of the tests to find affiliation, if a combination of all of them put together leads the SBA to believe that you're affiliated, normally they will make an affiliation determination. This is not clear in the rules, to me at least, that came out late Friday night. You've got those 4 tests. So if you fall under any of those 4 circumstances, they can find affiliation based on any one of them. What's not clear to me is if they're going to do kind of an all-in totality based on those 4 circumstances where you might not squarely fall within one, but you got kind of factors going on in each of the 4. So that's a little bit of an open question, but certainly if you are affiliated based on any one of those 4 items, they're going to find an affiliation.
So I will just note on this, I don't see how operationally they apply the totality of the circumstances test because the banks can't do it. The banks don't want to be in the position of making the determination. And the SBA doesn't have the resources for you basically to appeal up to them to ask. So I feel like as a practical matter, if you're under one of those four, you're going to be affiliated. And if you're not, you likely won't. But from an applicant's perspective, be honest and truthful in responding to the questions, because failure to do so is a felony under federal law. And as long as you've done that, then it's kind of on the bank and on the SBA beyond it.
Here's a question on ownership. And I just lost it, but if you're 100% owned by a foreign entity, but based domestically, are you eligible?
It depends. So the way that the business concern definition is written under SBA rules, you have to be a for-profit business. You have to have some presence here in the U.S., some physical presence, and you need to either have your primary operations here, or you need to significantly contribute to the U.S. economy by paying taxes or using U.S. labor, supplies, so on and so forth. So it's a little bit of that sort of threshold question of what's going on at the US-based entity level. But also remember, for purposes of those affiliation rules, if you're 100% owned by that foreign affiliate, you count that foreign company's employees, full-time, part-time, and other bases in your employee count. So for a lot of people, this is going to kick them out based on the employee threshold on a counting issue. Less than are you significantly engaged in the U.S. economy issue.
Okay. Scott, I think this is one for you. Are marijuana growing operations and distributors eligible?
No, they're not. If you engage in a business that's deemed illegal under federal law, you're not eligible for participation in the program. And
okay.
I'll just remind people that we didn't write the rules. In fact, we would have made them quite differently. We're just reporting.
Okay. Let's see, I did that one. Can you please explain affiliation rules around 50% equity? An investor must have 50% to trigger, and what does common management mean?
So I can tell you what the guidance says that came out on Friday. So you will be found to be affiliated if you have an equity owner that has greater than 50% equity ownership in the business. Common management is looking at folks like board members, CEOs, similar type management figures. If that person can control the management of your business and another business, then you have a common management affiliation.
Sorry.
Okay. Will Indian tribal-owned casinos fall under special counting rules?
So,
so this is a tough one.
Yeah, I mean, there's two answers to it. One is there should be under that 72 NICS code, so they get special treatment. They also get special treatment as a tribal entity, which relieves them from some of the affiliation rules. The problem is, if you garner more than 25% of your revenue from gaming activities, they exclude
one-third,
you're excluded from the program. We've seen no evidence that does not apply to tribal-owned casinos, but that's an open question. The other thing I wanted to say on the last question is, on these control issues, you do have the opportunity when you submit these applications to add additional materials. They shouldn't be long because people are overwhelmed, but to the extent you have a knotty control issue, you may want to submit one page, either have your law firm do it or do it yourself, explaining why you're not affiliated with other entities, why there is no common control, as a safeguard.
Okay. Scott, what about seasonal businesses? We're a summer camp and we're not even sure if we'll be able to open. Can we use the PPL to pay administrative who are only seasonal but also long-term employees, as opposed to college kids who are there in their first or second year of working?
So seasonal businesses, they can use a special qualification period for determine their loan amount. Kate, that's February 15th through June 30th of 2019, right?
That's right.
So they would base their loan eligibility on their average monthly payroll for that period of time last year as opposed to the calendar year. And then they could get 2.5 times that amount as the loan, and they could pay anybody they want to with that under the program. Is again, only up to 100 grand, not that can't necessarily have many employees over that, would count in the calculations on both ends. And you'd have to use at least 75% of the money on payroll. Now, one thing a business like that could theoretically do, if it was planning to start and it wasn't able to exhaust all 75% on its year-long employees, is it may consider some advanced payments for those counselors, things like that. There may be some structuring opportunities that would bring them into compliance.
So the question is what if your independent contractors are physicians who solely work for us, nonprofit mental health care providers? I don't know what the question is.
Yeah, that unfortunately, the way they wrote the rules, those folks need to go apply for their own loan. And it's, you know, as we read the statute, there is no such limitation, but that's how they came out on the rules.
Okay. What about unemployment insurance costs? Are they included in the eligible payroll costs?
No.
No. For health insurance benefit premiums, wait a minute, it just rolled up. Can we use the entire monthly premium or only the portion that we pay towards the premium?
You can't double count. And so normally, so it's probably really going to be the employer portion, but you're going to include the employee portion in the component of it's part of their salary, right, that they're directing over.
Okay. Does rent cost include CAM charges?
Include what kind of charges?
CAM, operating charges. Yes.
They haven't defined it.
It's rent.
Yeah.
It's your
Yeah. There's no parameters around that rent word in the statute. So anything that you would normally pay as part of your rent payment, I think you're probably fine to include.
I concur.
Okay. We thought we could receive a PP loan, also take the tax credit, but it sounds like you must reduce the payroll in 8 weeks by any tax credit submitted. Scott, I was under the impression you couldn't do both.
You can't do both.
Okay.
And it's done quarterly, right? And so I guess we've just finished the first quarter. As you look at it and you qualify for the tax credit, you're going to have to evaluate that versus the PPL.
Is the 500 employee maximum based upon an average head count as of a certain date? We're currently just over 500. If we lay off some employees and drop below 500, we're eligible.
Well, first of all, if they're right around 500, they may want to check their industry code because it may allow you to have more employees. So this is an open question. We originally read it to say it was the number of employees on the date you actually apply from the program. Typically for SBA loans, they look at the average number of employees broadly defined. So it would include part-time, 1099 employees, et cetera. They look at it as an average over the last calendar year. We think the SBA may give some guidance on that, and it's the issuance that it should have today or tomorrow. As a general matter, I think you're better off using the most conservative number. I think if you're laying people off to get to the number, there may be some issues for you down the road.
Okay. How do we calculate FTEs for part-time employees? Is it based on 30 hours or 40 hours?
We don't know yet. That is an open question. That's a big one that they need to answer in those forgiveness provision rules. So, most of the universe uses 40 hours a week for full-time, but anyone who's been dealing with the Affordable Care Act for the last decade knows that it could be something less than that. So we're still waiting on that information.
Okay. I am going to go ahead and close this out because there are 293 questions and I can't keep up with them all. So I would urge those of you with questions, I would urge you to contact either review the presentation, which a lot of these questions are answered in the presentation, or reach out to your broker. You are in great hands with your broker. Your brokers are the most talented in the industry, and they're your advocates, and you should reach out to them. They're the best of the best. So with that, Scott, thank you. Scott and Kate, thank you so much for the presentation this morning. And these are difficult times and challenging times, and I hope this is helpful in giving you some clarity and insight in this really interesting program. We are going to follow up by sending a link out to the program so that you can share it. And Scott will also include a connection to the slides and the information that you have so that people can access that. And you're always welcome to, Steptoe is a great firm, and you can work with Steptoe anytime you want. So that was not a sales pitch. That was just a comment. Okay. With that, thank you all for your time today, and stay healthy and safe. Thank you.